Welcome back to the deep dive. Um, if you opened your portfolio today, took one look at the information technology services sector, and immediately wanted to just close your laptop right back up.
You are definitely not alone. I mean, to call it a sea of red might actually be putting it mildly today. It looks like an absolute crime scene in the legacy tech sector.
It really does. And, usually when we see a massive drop like this across a whole sector, it's tied to broad economic data, like inflation, or a jobs report, or the Fed doing something unexpected. But today is different.
Right, today feels like a historic shift driven by a single, highly specific technological announcement. It's one of those rare days where the actual ground underneath an entire industry just moves.
Exactly. So here is our mission for today's deep dive. We aren't just reading the ticker tape to you. We are going to perform a full-spectrum, expert stock news journalistic report. We've pulled the raw data straight from the stock screener. We have the latest analyst notes, and we are isolating the top 3 stocks listed for swing trading based on today's historic volatility.
We are looking at the carnage, sure, but we're also looking for the opportunity. Because in a market moving this fast, there is always a trade setup if you know where to look.
Absolutely. And just to set the scene with a quick sector overview, we are focusing on information technology services. We have absolute giants like IBM down over 13%. We have Cognizant, ticker CTSH, down 6%. And this is all happening against a backdrop of aggressive AI news and some geopolitical headlines regarding tariffs.
It is a total pincer movement. You have this sudden, massive technology threat on one side and a macroeconomic threat hitting them on the other.
Now, because percentages, 13% down, 6% down, they can feel a little abstract until they actually hit your bank account. So we are bringing back a segment we haven't done in a while. We were calling it Fun with Paper Money Math.
I love this segment. It's where the rubber really meets the road. Or, I guess today, where the wallet meets the shredder.
Let's hope not. But here is the premise. For each of the 3 stocks we analyzed today, we're going to simulate a $5,000 swing trade position. We will calculate exactly what these wild percentage moves mean in terms of real hard dollars lost or gained if you were holding the bag, or if you managed to catch the swing.
It is the single best way to visualize risk. It stops being a line on a chart and starts being, a car payment.
Exactly. But before we officially open up the ledger, we just have one quick piece of housekeeping.
Right. Our standard, very subtle, but very mandatory disclaimer. We are not financial advisors, and this deep dive is strictly for educational and entertainment purposes. You should always do your own thorough due diligence before putting any of your hard-earned cash into the markets.
All right, roadmap time. We have 3 stocks on the docket. First, IBM, the blue chip giant, taking a historic tumble. Second, CTSH, Cognizant, which looks like collateral damage but might actually be a hidden value play. And third, our high volatility wildcard, Applied Digital, ticker APLD.
The one stock that apparently decided to completely ignore the memo today.
Let's start with the big one. International Business Machines Corp. Ticker symbol IBM. If you looked at the screen today, your jaw probably hit the floor. The stock is down a staggering $33.81 per share.
Which is a 13.15% drop.
Right, closing the day at $223.35.
Let's just pause on that for a second. For a high-growth tech startup, a 13% drop is just a bad Tuesday. But for a blue-chip, dividend aristocrat-style stock like IBM, a 13% drop in a single trading session is basically a crash. It is incredibly rare. This isn't just a missed earnings report. This is an existential rattle.
So let's unpack the why. What on earth caused a $200 billion company to shed that much value in 6 hours? Our sources point squarely at a company called Anthropic.
Right. Anthropic, which is a major competitor to OpenAI, launched a new AI tool today called Claude Code. Now, usually a new chatbot launch doesn't tank a legacy giant, but this tool specifically targets something called COBOL modernization.
Okay, COBOL. For you listening who aren't software engineers from the 1970s, can we explain why this matters? This is an ancient programming language, right?
It is ancient. It stands for Common Business-Oriented Language, and it was developed way back in 1959. But here's the kicker. It still runs the world. Most global banking systems, government mainframes, insurance ledgers, they all run on COBOL.
So it's sort of the invisible foundation of the global economy.
Exactly. And because it is so old, very few people actually know how to write it or fix it anymore. So for decades, IBM has made a fortune, an absolute fortune, because their consultants are the only ones who know how to maintain that legacy ground. It is a massive, highly reliable revenue stream for their consulting business.
It's the old guard tax. If you want your bank to keep processing transactions, you pay IBM.
Until today, the market looked at this. They looked at Anthropic's tool, which claims it can automate the modernization of this code, essentially translating it into modern languages in seconds. And the market collectively said, wait a minute, AI just replaced IBM's most expensive consultants.
That is the textbook definition of the AI scare trade. It's not just about AI getting smarter, it's about AI specifically targeting a high-margin human business model. But it wasn't just the AI news, right? We also saw some headlines today about the Trump administration invoking the Trade Act of 1974.
We did. There's talk of a 15% global tariff.
And just to be completely clear to you listening, we are impartially reporting the contents of the news sources here.
Yeah.
We never take political sides on this deep dive. We're strictly looking at how these policies impact the market data.
Exactly. Regardless of the politics, a 15% tariff introduces a thick layer of uncertainty for a massive global entity like IBM. But if you look at the trading volume and the sentiment today, the tariff was the spark, but the Anthropic news was the fuel. The selling pressure was overwhelmingly about that business model threat.
Let's look at the basic valuation analysis, because usually people buy IBM specifically for safety. IBM has a market cap of roughly $208.7 billion. Their PE ratio, price to earnings, is sitting at 20.03, with a dividend yield of 3.02%.
And that PE is the real sticking point here. A 20 PE is generally considered pretty reasonable for a solid tech company. But a PE ratio is fundamentally a measure of confidence in future earnings. Investors are asking, if AI erodes their consulting margins, are those future earnings actually real?
Because if the E in that equation...
The earnings, exactly.
Right, if the earnings go down, the price has to come down to match it. Investors are suddenly wondering if 20 is just too rich for a company that might be losing its primary moat. So let's talk technical analysis for the swing traders out there, because the chart looks broken.
Broken is an understatement. It's shattered. The price action today was brutal. The stock crashed straight through its 20-day, 50-day, and 200-day moving averages all at once. The SMA 20 is down 20.60%.
And what about the RSI?
The Relative Strength Index. For those who don't watch technical charts, think of the RSI like a rubber band. If you stretch it too far up, it snaps back. If you stretch it too far down, it bounces. Usually, anything under 30 is considered oversold. The rubber band is stretched to the max. IBM's RSI right now is at 22.84.
So normally, a setup like that screams buy the bounce.
Normally, yes. But when you have a fundamental shift, like a new technology, making your core business obsolete oversold can stay oversold for a very long time. It's what we call a value trap. You buy the dip, and the dip just keeps dipping.
And looking at the volume, it was absolutely huge. 19.38 million shares traded today versus an average daily volume of just 4.56 million. That is not retail traders panicking on Robinhood.
No, that is institutional selling. That is pension funds and mutual funds dumping the stock. That is high-conviction professional selling.
Okay, time for our first round of fun with paper money math. Let's make this real. Imagine a listener. Let's call him Safe Bet Sam. Sam held a swing position entering the day. He had $5,000 invested in IBM based on the previous close of about $257.16. He thought he was parking his cash somewhere stable.
Poor Sam. All right, let's run the numbers. At that starting price, his $5,000 buy-in would have purchased approximately 19.44 shares.
Then the Anthropic news hits the wire. The stock drops $33.81 per share.
So you take his 19.4 shares, multiply that by the loss of $33.81 per share. That is a total loss of $657.26 in a single 6-hour trading session.
Ouch. So that safe $5,000 investment is now worth roughly $4,342.
That is a 13% haircut on a defensive dividend stock. It really illustrates how violently the narrative can change in this market. You wake up thinking you own a utility, and you go to sleep realizing you own a typewriter factory in the age of the iPad.
Speaking of typewriter factories, or at least companies caught in the same zip code, let's move to our second segment. Cognizant Technology Solutions, ticker CTSH. It feels like they got dragged right down in the exact same current.
They absolutely did. Cognizant is in the same sector information technology services. They are down $3.90 today, which is a 6% drop, closing at $61.13.
It seems like the exact same logic applies here. If AI can write code, you don't need to hire Cognizant's massive armies of developers to do the grunt work.
That is the fear, yes. The Anthropic COBOL tool threatens their legacy systems consulting business just like it does IBM's. However, there is a major counter-narrative here that the market might be completely ignoring in the panic.
Right, I was reading through the source material, and Cognizant actually had some very positive announcements recently. They just expanded a strategic partnership with Google Cloud to operationalize something called agentic AI. And they also announced a partnership with Adobe.
And that is the fascinating disconnect for a swing trader. While the broad market is aggressively selling them off as a victim of AI, Cognizant is furiously trying to position itself as the implementer of AI for enterprise clients. The expert question here is this an overreaction? Are investors throwing the baby out with the bathwater?
Well, let's look at the basic valuation, because it looks a lot cheaper than IBM to begin with.
It really is. Cognizant is trading at a PE ratio of just 13.41. That is significantly cheaper than IBM's 20. And their PEG ratio, that's price earnings to growth, is 1.23.
Can you quickly break down the PEG ratio for us? Why does that matter?
Sure, the PEG ratio compares the price of the stock to how fast the company's earnings are actually growing. A PEG of 1.0 is generally considered fair value. A PEG of 1.23 suggests it's very reasonably priced, assuming they can maintain their growth rate. Unlike IBM, which is priced for pure stability, Cognizant is priced much more for value.
And they did just beat their Q4 earnings and revenue estimates recently.
They did. Fundamentally, the actual business is still performing as of today, unlike the stock sentiment, which is driven purely by future fear.
So let's look at the technical analysis. Is this a dip buy opportunity, or are we just catching a falling knife?
It is an aggressive play. The RSI is 21.71. That is extremely oversold, even more so than IBM. And the stock is down 27.75% for the month. It has just been battered.
That is brutal. Almost 28% in a single month.
It is. But for a highly aggressive reversal trader, an RSI under 22 is a classic buy trigger, assuming the psychological support level at $60 holds firm. However, look at the trend lines. The 20-day simple moving average is down 17.49%. The momentum is practically pointing straight down to the floor. You are definitely trying to catch a falling knife.
Let's try to catch that knife with our paper money math. Let's say you are a brave contrarian trader. We'll call her Contrarian Connie. She sees the drop today, and she invests $5,000 right now at the close, betting on a dead cat bounce a quick recovery swing tomorrow morning.
Okay, risky move, Connie. At the closing price of $61.13, your $5,000 buys you roughly 81.79 shares.
Now, let's say the market calms down tomorrow. Traders realize, hey, they have that Google Cloud deal, and the stock recovers just half of today's loss. That would be a move up of about $1.95.
In that scenario, your 81.79 shares times a $1.95 gain gives you a quick profit of $159.49.
Not bad for a single day's work.
Not bad at all. But you have to weigh the risk on the other side. If the AI scare continues and the stock drops another 5% to match its monthly downtrend, you are losing $250 just as fast. It is a high-risk setup, but unlike IBM, the valuation cushion underneath it is a little softer.
Okay, let's pivot for segment 3. We've talked about the falling giants. Now let's talk about the high-octane volatility play. Applied Digital Corporation, ticker APLD.
This is a completely different beast. While the boring, safe IT services stocks were crashing today, APLD actually closed green.
It did. The stock is up 96 cents, a gain of 3.31%, closing right at $30 flat. And this is despite having a terrible week overall. It was down nearly 15% leading up to today.
And what makes this green close so impressive is the news flow surrounding it. It was mostly terrible news.
Yeah, let's look at the headlines for Applied Digital. NVIDIA, the absolute kingmaker of AI, the company everyone on Earth wants to be associated with right now, dispose of its shares in Applied Digital. They completely exited the stake.
That is usually a death sentence for a stock like this. When NVIDIA sells your stock, everyone sells your stock. It's like the cool kid leaving your party. On top of that, there were mounting fears of neocloud contagion because of financing issues at CoreWeave, which is another major player in the data center space.
So why on earth is the stock up? NVIDIA leaves, the sector is shaky, the macro environment is red. Who is stepping in to buy?
There is a bull case theory circulating today. Analysts at Roth MKM published a note saying they believe a hyperscaler lease is imminent. Basically, the market is betting heavily that a massive tech company, maybe an Amazon, maybe a Google, is about to sign a massive lease for Applied Digital's data center capacity.
So the potential of a massive new real estate deal completely outweighed the NVIDIA exit. That is a serious tug of war on the tape. Let's look at the basic numbers, because this stock sounds wild.
It is exceptionally wild. The most important metric here is the beta. The beta is 7.22.
7.22. Okay, explain beta to me like I'm 5.
Okay, think of the broader stock market like the ocean. If the ocean moves up 1 foot, a normal boat moves up 1 foot. That is a beta of exactly 1. A beta of 7.22 means if the ocean moves 1 foot, your boat either launches 7 feet into the air or it crashes 7 feet underwater. It measures volatility relative to the S&P 500. This stock is over 7 times more volatile than the market.
That is not an investment. That is pure adrenaline. And looking at the short float, it's at 34.11%.
That is a massive number. That makes it a classic short squeeze candidate. With 34% of the float sold, short meaning institutional traders are actively betting against it. Any piece of good news, like that hyperscaler lease actually being confirmed, forces those short sellers to panic buy the stock to close their losing positions. That forced buying frenzy is what sends the price skyrocketing.
That perfectly explains the resilience today. The shorts might be too scared to press their luck on a day when a lease rumor is floating around. Let's check the technical analysis. It closed exactly at $30.
That $30 level is a huge psychological battleground for traders. And here's a key technical difference from IBM and CTSH. Look at the 200-day simple moving average for Applied Digital. It is actually up 38.38%.
So the long-term trend is actually pointing up.
Exactly. IBM and Cognizant are in severe downtrends with broken charts. APLD is in a long-term uptrend. It's just experiencing extreme short-term volatility. The RSI is 43.04, which is totally neutral. It is not oversold. The buy trigger here isn't the RSI condition, it is the price resilience. It held the $30 line despite NVIDIA selling. That shows incredible underlying strength.
Let's run the paper money math on this one. This is strictly for the volatility traders.
The adrenaline junkies.
Exactly. Let's say volatility events bought $5,000 worth of APLD right at the open today. Based on the previous close of around $29.04, he was betting on an intraday rebound, completely ignoring the NVIDIA news.
Okay, so $5,000 divided by 29.04 gets Vince approximately 172 shares.
The stock moved up 96 cents today.
So 172 shares times a 96-cent profit per share. That is a gain of $165.12 in a single day.
And that is the stark contrast of today's market. Safe Bet Sam lost over $600 in IBM. Volatility events made $165 in the riskiest stock on the board.
It really proves that risk isn't always about the asset class itself. It is about understanding the specific narrative of the day. The AI scare actively hurt the legacy consulting players, but the infrastructure players, the companies actually building the data centers like APLD, are still seeing massive forward demand, even without NVIDIA holding their stock.
Let's zoom out and wrap this up with a comparative valuation analysis. We have the screener data for the whole IT services sector. Is IBM just an outlier today?
When we look at the direct peers, IBM's valuation really stands out, and not in a good way. We mentioned IBM has a PE of 20.03. Compare that to DXC Technology, which is trading at a PE of just 5.10, or Kyndryl ticker KD sitting at 10.88.
So IBM looks very expensive compared to its direct neighbor.
Very expensive. But we have to be incredibly careful of value traps here. DXC is down 11.24% today. Kyndryl is down 8.79%. The whole neighborhood is bad. It isn't just IBM. The entire legacy IT services sector is being repriced downward simultaneously.
It is a massive sector rotation. Institutional money is fleeing these consulting firms.
But let's look at what the Wall Street analysts think, because their price targets are wildly disconnected from today's actual price action.
Yeah, for APLD, the recommendation rating is 1.00. That is a strong buy. And the target price is $49.83.
That is massive upside from $30. The analysts are clearly betting heavily on that hyperscaler lease coming through.
For IBM, the recommendation is 2.22, which is more of a hold or mild buy. But the target price is listed at $326.
That target implies the analysts were very, very wrong about today's price action. That target is $100 higher than the current price. I suspect we are going to see a wave of downgrades and price target cuts in the coming days as analysts digest the Anthropic news. They just haven't updated their models yet.
And for Cognizant, CTSH, the recommendation is 2.13 with a target of $90.86.
Again, a massive gap from the current $61 price. It suggests that if the AI fear is overblown, Cognizant has a lot of room to run back up. But that is a very big if.
So what does this all mean for you listening? Let's summarize the overall lesson of the day.
I think the lesson is crystal clear. IBM and Cognizant show us that supposedly safe stocks are not safe at all when a fundamental technology shift threatens their core business model. COBOL was an impenetrable moat for 50 years. Today, AI just built a bridge right over that moat.
Yet on the flip side, APLD shows that high short interest and high beta can offer swing trade profits even on a terrible news day, provided the underlying bullish thesis like data center demand is strong enough to force the shorts to cover.
It is a market of highly specific narratives right now, not just general trends. You can't just buy tech blindly anymore. You have to buy the exact right kind of tech.
Here is a final provocative thought to leave you with. The market just wiped billions of dollars off IBM and Cognizant today because an AI can now write and modernize COBOL code. We assume this means companies won't need human consultants anymore. But who is going to verify that code?
That is the trillion-dollar question right there.
If an AI rewrites the core banking system of the entire world, are we really going to trust it blindly without human oversight? Or are we witnessing not the death of the IT consultant, but just the evolution of their tools? Maybe IBM doesn't die at all. Maybe they just transition into being the premium AI verifiers.
And if that is the case, this 13% drop might turn out to be the buying opportunity of the decade. Because someone has to be the adult in the room when the AI inevitably hallucinates a line of bank code.
A very big if, but definitely one worth thinking about. Before you make any moves, check your own stock screener. Look for those oversold RSIs in the IP sector, but verify the volume before you jump in.
And always check the news catalyst. Never catch a falling knife unless you know exactly why it fell in the first place.
That is all the time we have for today's deep dive. Thanks so much for listening, and we will catch you on the next one.